There's another model which is sort of a more advanced version of the Takahashi and Alexander model. It's actually developed by a company that Northfield partners with exclusively. That model is called the Boston model. And apparently it's a company that's also based in Boston, but it's an abbreviation that is both speed time option normalized. And what that means in practical terms is that this factor here actually accelerates over time as the manager, as time passes by, doesn't have the option to wait to liquidate a particular deal. So you might see in practice the Takahashi and Alexander model saying that managers in the initial periods of the fund liquidate slower than what the model predicts. And that's captured by the fact that the manager has the option to wait. So this fine-tuning actually is producing better empirical results. So this is where things really start to get interesting, where the risk modeling, the uncertainty is introduced. When we have contributions, remember that shape that we saw before, it's an expectation that has certain point estimates over the future. When we introduce the uncertainty around it, we have a distribution range. And you can see those curves, they're actually a little squeezed, but if they were taken in isolation, you'll see that they're actually sort of looking like bell-shaped curves. And they give you the probability range around how much I can expect with certain level of probability to have to commit to actually contribute to the fund at a maximum or at the minimum, because it does not depend on the LP, it depends on the GP. That's why there is uncertainty on the side of LP what they have to expect they should be paying. And this is really more informative, because not only we're getting a point estimate how much you have to contribute to a fund in, say, quarter 6 or year 5, but sort of give you a range with some confidence. You can say I have to contribute X amount of dollars with, say, 60% probability. And this kind of information actually is useful, and actually it's very central to the whole optimal allocation. If you remember where we started from, where we wanted to make sure that liabilities in the future are met with a certain confidence. So what we saw before in the previous slide was the contributions, but this time we're looking at the distributions. And again, these are real tiny bell-shaped curves here, distributions that get really wide, and that's why they look like lines. But again, you have to think of this as a probability range of distributions occurring over the lifetime of the fund. And these are periodic. So this number here, for example, will tell us in this quarter, with certain probability, we have to expect that the distribution is going to be X. This is not cumulative over time. And that's a key distinction. So this partnership which Northfield has, I mean, for all practical purposes, you have to assume that this functionality is accessible through Northfield, but the key kind of feature, apart from the cash flow forecasting model, is that they're also able to, they have a simulation algorithm which is really powerful. Actually, it makes, you can think of it as a Monte Carlo simulation with 10 to the power of 21 different paths. So any of the paths that, any of the simulation, Monte Carlo simulations you heard about, probably somewhere between 5,000, 10,000, 100,000 different paths, but these are 10 to the power of 21 different paths. And the reason we have to observe paths rather than points is really this cumulative accumulation of cash flows over time, distributions and contributions. To be able to project, like for example, in the first case, in year one, what is the cumulative cash flow we're going to get after 4 quarters, or in after 12 quarters in year 3. You actually have to project all the different paths that will reach that horizon, and what those cash flows, cumulative cash flows, based on those periodic cash flows that you just saw, will look like in year 3, year 5, year 7, year 11. And this is really what you see here is the distribution you'll pay off from the investment. That's exactly what it is, because you accumulate all the cash flows that occur over time. If you keep those cash flows and invest them in, say, riskless bonds, or just keep them under the mattress, or whatever you want to do with them, but you just accumulate them over time, your statistical distribution is going to look something like that. So we'll just go a little bit on a tangent here and mention that this statistical distribution is very key to come up with the risk-aware valuation of the fund. And you can think of it as a derivative pricing, like if you have an option and you know the payoff of the underlying instrument, you can use the distribution of the underlying instrument to price the option. So it's very kind of similar, but this time we're not pricing an option, we're pricing fund investment, private equity investment, for example. It could be applied both at the individual deal level as well as the fund level. Again, the fund is more complex because of these contribution and distribution patterns that accumulate over time. For one company, it's actually more simplistic. And you also have these overlay waterfall provisions that also have to be properly incorporated. But essentially, when you have that distribution in the end, you're looking for the price that will make an investing different in investing in that particular investment, as opposed to a riskless investment. And that's really what is called a certainty equivalent type of pricing. And it's one of the prescribed approaches to pricing private interests by probably the 3 major authoritative bodies in the industry that came up with guidance on these issues. Probably the most prominent of them is the AICPA, which is the American Institute of CPAs. Even though it says American Institute, actually it's not US-centric. A lot of the principle behind it are actually global in nature. And for that reason, the IPEF, which is the European equivalent of ICPA, the International Private Equity Valuation Board in Europe, adopted a lot of the principles behind it too. For those of you who are CFAs, the CFA Institute, just about the time that the CPA Institute issued their own guidance, the CFAs also did that, which is earlier this year, like at the end of the summer. But I guess the cornerstone point is that this certainty equivalent approach, which in the derivative pricing world is called risk neutral valuation, is probably the most sophisticated type of approach, in the sense that it can capture all these dynamics, because you can do market comparables, discounted cash flows using, say, some discount rate that's derived by CAPM or something like that. But these are much more simplistic than what is necessary to capture the real dynamics behind the fund. So this is the approach that's adopted by us. And if you think about it, at any point in time, you can come up with valuations of the fund or a portfolio of funds, which you want to use as a benchmark, as quasi-market valuation, that the market is going to value that fund at this point in time. When if it's not traded, you can create synthetic benchmarks that using this valuation methodology. What is also important is that the general partners, when they provide the quarterly statements and provide the NAVs of the funds, they actually use accounting methodology to create those valuations, and they're in no way standardized. There's a wide divergence of how they do that, which essentially leaves you uncertain really about your real risk-aware valuation. So we believe that this risk-aware approach actually is creating a comparison of value, which at the least is apples to apples, rather than just kind of assuming that what the GP gives you is correct. And there's a lot of identified issues why GPs will want to provide biased reviews of the value of the fund. And the major one is that their asset management fees and their carried interest is based on that. So they certainly have an incentive that might be different from that of the investor, the LP. So just using the same methodology over time, you can project the residual value of the fund just at the current point, but project it over 1, 2, 3, 4 years until the fund is depleted, where you see that curve of residual value is going to 0. For those of you who have done performance evaluation of private equity vehicles, you're probably familiar with the next set of curves, which are the paid-in multiples, the DPI, RVPI, and TVPI. The DPI is the ratio of the sum of all the distribution to date to all the going capital. The RVPI is, again, the denominator is the same, but the numerator is the residual value. And you can think about it, if you add the two, it gives you your total payoff of the fund, which is the TVPI. So you can also project these kind of metrics. They're not backward looking. I mean, there's a lot of data that you can, a lot is an overstatement, but there's data about the past, but this actually can give you an expectation about the future for the same metrics, and you can evaluate different funds based on that. One of the kind of nice features is that if you have a portfolio and you want to see if it's well diversified and what will happen if you add a new deal, what in Northfield we call the optimal deal flow, how you add stuff and it affects the value of the fund, makes it more or less risky. It affects also the value of the fund, because if this is a less diversified fund with the same expectation, an investor under the certain equivalence pricing will require a lower price, so your values will be lower. And actually, if you do this type of analysis, you're able to observe that. And a curve that's for a fund that's more diversified will essentially have higher value than the one that's less diversified, which is what you would expect.